Welcome to this explainer. Look, if you've been watching the charts lately, reading the latest economic data, and feeling like the numbers just aren't adding up to the reality on the ground, you are definitely in the right place. Today, we're undertaking a deep structural diagnostic of the H2 2026 market economy, and we're going to break down exactly what is happening under the hood. So here's the massive question we really need to answer today. What actually happens when unstoppable exponential digital momentum hits a very stubborn, immovable physical wall? We're living through a moment where digital ambitions are scaling faster than anything we've ever seen. But as we're about to explore, the physical world has very real limits. Think about the economy for a second, not just as a line on a graph, but like a massive geological structure. Up on the surface, you see the rolling hills and the peaks. That's the data you hear reported on the evening news. But right beneath that surface, there are hidden, dangerous fault lines building up an immense amount of pressure. To map out all this pressure, here's our roadmap. We'll start with the surface scorecard, then dig into the shifting macro tectonics. From there, we'll diagnose three critical fault lines: the yen carry trade, physical bottlenecks, and grid strain. Finally, we'll look at the downstream impacts and the ultimate collision waiting for us in H2. All right, let's dive right into Section 1, the surface scorecard. Now, if you only glanced at the headline numbers for Q2 2026, you'd honestly think we were living in a flawless economic utopia. I mean, we're looking at a massive 80% surge in the semiconductor sector. It's just off the charts. And this historic momentum, it's being fueled entirely by the premise of an uninterrupted, infinite AI investment cycle. Capital is just pouring in on the assumption that this growth will not, and literally cannot, stop. And it's happening alongside some broader historic momentum, too. The S&P 500 peaked at plus 14.9%, which is its best quarter in 6 years. The Nasdaq is up 20%, but the real anomaly here is a 26.2% expected Q2 earnings growth. To put that in perspective, that is double the previous record for non-recession recovery period. So on the surface, structural integrity looks absolutely perfect. But moving on to Section 2, shifting macrotectonics. Right beneath that booming surface, the tectonic plates that actually govern global capital are aggressively shifting. First off, we're seeing this massive sector rotation. Information technology, despite all the wild AI hype, actually cooled down to just 2.6% growth as cyclical sectors took the baton. But here's the crazy part. Look at the real estate illusion. Nominal home prices technically ticked up 0.8%, sure, but inflation totally ate that growth. In real terms, actual asset values in real estate have fallen for 11 consecutive months. So the surface screams growth, but the underlying math, it's screaming contraction. And these shifts are bleeding into the broader macro environment governing capital flows. On one side, you have what we call monetary gravity. Fed Chair Warsh is basically enforcing a hawkish silence, which forces the markets to react purely to raw data. That's setting us up for 3 modeled interest rate hikes by late 2026. Then, on the flip side, political capital has been completely rewired. Following a recent 6-3 Supreme Court decision, there's this massive, deregulated pipeline of campaign cash just flooding in ahead of the midterms. These are huge, foundational shifts happening right under our feet. Which brings us to Section 3, 3 critical fault lines. Keeping those shifting tectonics in mind, we're at the core of our diagnostic today. We need to examine 3 critical fault lines that are currently under maximum stress, literally ready to snap. Fault line 1 is the yen carry unwind. Here's how this plays out. Step 1, the fuel. Japan's yen hits a 40-year low at 162 to the dollar. Step 2, hedge funds borrow the super cheap yen to heavily load up on US tech stocks. But step 3, that's where the fault line snaps. The Bank of Japan hikes rates to a 31-year high of 1%. The big takeaway here is the violent snapback risk. Remember August 2024? A tiny hike sparked a massive global unwind. Well, this current setup is primed for a shock that's so much bigger. Then we have fault line 2, the physical AI bottleneck. We always hear about software scaling exponentially, right? But AI requires physical, tangible hardware. At the top layer, you've got the silicon. Companies like TSMC are aggressively ramping up packaging, with their server revenue projected to grow a staggering 74% in 2026. But it's the layer beneath that which is totally fractured. That bottom layer is called the substrate base. This is the foundational chip layer that TSMC actually does not control. They have to rely on these smaller, highly constrained suppliers for this. Because of this harsh physical reality, as giants like Nvidia and Amazon ramp up their new platforms late in the year, we are facing what's likely the biggest ever component supply mismatch in H2 2026. You just cannot code your way out of a physical substrate shortage. And that feeds right into fault line 3, the grid strain feedback loop. It's a brutal chain reaction. Step 1. Extreme heat hits 200 million Americans. Step 2. That heat causes massive generation inefficiency. I mean, nuclear and gas plants literally lose their output capacity when it's that hot. Step 3. Everyone cranks the residential AC, and that massive demand spike collides directly with the inflexible baseline power draws of AI data centers. Step 4. The system just breaks. We're talking emergency protocols where grids have to mandate utilities to force data centers onto backup generators just to stop widespread residential blackouts from happening. Let's pivot to Section 4, downstream consumer impacts. So why do these giant macro fault lines actually matter to you? Well, because they cascade directly into our everyday wallets. Think of it as a device inflation waterfall. At level 1, AI hyperscalers gobble up all available capacity. For example, Micron's new factory isn't even going to produce memory chips until 2027. Then, at level 2, Samsung and SK Hynix see this massive shortage and aggressively jack up their memory prices, totally squeezing their tech clients. And level 3, that brutal cost gets passed directly down to the consumer as margins compress. At the retail counter, this squeeze is absolutely brutal. Apple MacBooks, those prices are up 18%. The Apple TV, a massive jump of over 50%, hitting $199. Microsoft Xbox consoles are up $150, heavily driven by storage costs that could literally double by 2027. So the physical bottlenecks of AI are directly driving up the cost of your everyday digital life. All right, Section 5, survival strategies. With all these immense pressures bearing down, we're seeing some rapid, pretty radical corporate metamorphosis going on. Just look at 2 totally different survival tactics. MicroStrategy is ditching its identity as a passive treasury to become an active asset manager. They're abandoning the pure HODL strategy, actively selling Bitcoin to build a massive US dollar reserve. Meanwhile, legacy brand AOL, now under Bending Spoons, is transforming into this aggressive startup roll-up, targeting an $18 billion valuation. Companies are literally having to rewrite their DNA just to survive right now. And finally, Section 6, the ultimate collision. When you stack up the reality we just lived through against the expectations we're heading into, the divergence is staggering. In the first half of the year, the reality was pretty sweet. Benign data, huge AI field expansion, and safe havens like gold hitting absolute record highs. But the H2 expectations? They're severe. Companies now have to somehow pull off massive margin expansion to convert low teens revenue growth into double-digit earnings. On top of that, we're staring down 3 potential rate hikes instead of cuts, and those safe havens are bleeding. Gold just suffered its worst quarter in 13 years, and crypto is seeing a massive wave of speculative exits. Bringing all of these data points into one final synthesis, we essentially have 3 massive forces crashing into each other. First, the digital mandate. These AI hyperscalers are scaling aggressively with price inelastic demand. Second, macrogravity, hawkish monetary policy, and that ticking time bomb of the yen carry unwind. And colliding head-on with both of those are physical constraints, the substrate bottlenecks, the power grid exhaustion, and the hard manufacturing limits. If you take away just one single thing from this entire explainer, make it this. The 2026 market is defined by a singular tension. Digital software ambitions are moving at exponential speeds, but they are colliding violently with the immovable laws of physical infrastructure, thermodynamics, and traditional monetary policy. The absolute winners in this market, they'll strictly be the ones who can actually bridge that physical gap. We've looked at the pristine surface data, and we've measured the massive tremors on the fault lines beneath. Mathematically, the pressure is undeniable. So, as the unstoppable force of digital ambition fully impacts the immovable object of physical reality, the only real question left to ask is, who will actually survive the H2 2026 tectonic shift? Thanks so much for joining me for this explainer. Keep your eyes on the data and keep learning.